that could provide strong evidence that this 3-week correction that has started, the market peaked about 4 weeks ago, but that this correction could get a lot more substantial and may in fact become officially a bear market.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
I want to talk a little bit about what happened today in the economy and the markets. There was very little discussion about the economy, unfortunately, during the debates. There was a lot of, nonsense that was really discussed. I don't know if debated is the proper word for it. So first of all, before the U.S. market opened, we did get some weak economic data coming out of Europe. All these PMIs numbers that came out weaker than expected. But then we got the release of the PMI for the U.S. The flat composite number for August came out this morning just after the market opened. So about 9:45 Eastern time, we got this release. And sure enough, in line with the rest of the world, the number was below estimates. The forecast, and I'm just going to break it down by sector, manufacturing versus service. So they were looking for the manufacturing index to come out at 48.8, and it came out at 47. That's weak. In fact, the range of estimates for that number ranged as high as 49.5, but as low as 47.5. And we actually came in under the low end of that range. So that's a weak number. And the service sector also weak, not quite as weak. It was supposed to be 52. It came out at 51. Now, anything above 50 is supposed to be expanding. So the service sector just barely, but solid contraction in manufacturing at 47, which I believe is the more important of the two sectors. Even though the service sector is larger, I think manufacturing is more important. And I've been talking about the fact that we've been in a manufacturing recession for a long time. And that's where Joe Biden and Donald Trump have something in common, because both presidents lied about the true state of manufacturing. President Trump claimed that he revitalized manufacturing and made America great again by restoring our manufacturing prowess. And now Joe Biden is telling the same lie, that we're having this renaissance in manufacturing, that it's booming. And both presidents were being dishonest. Manufacturing was deteriorating under both of their presidencies, and it continues as we become more and more reliant on imports. It's the foreign factories that are producing the stuff that we consume, not the American factories. Unfortunately, nobody really talked about this, stay focused on this. So as soon as that weaker than expected data came out, the bond market rallied. Now, why did the bond market rally? Well, the economy is weak. Well, we already know that. But this weak economic data comes out and traders buy bonds because that's what they've been programmed to do. It's like Pavlov and the dog, right? They salivate at these numbers and they react. The idea is, the economy is weaker. The Fed doesn't have to hike as much. The Fed might have to cut. Well, how many times are you going to react to the same data set? But we got it, and bonds were on the lows. I mean, they had been beaten up pretty bad. So I'm sure some of the longs, or the shorts rather, in the bond market decided to take some profits, and that's probably what kind of drove the movement. But the theory is wrong, and I've been discussing that on this podcast. A weak economy is not good for bonds. The idea is that it just means that the Fed is going to be easier, but that just means that inflation is going to be stronger. The real enemy of bonds is inflation, especially U.S. Treasuries, where it's not really default that is your risk, but devaluation, depreciation, inflation. is what drives down the value of the dollar, and that drives down the value of bonds. Again, too much money chasing too few goods, that's what causes prices to go up. Well, if manufacturing is going down, what does that tell you about the supply of goods? Well, it's going down too, or not going up as much as we need it. So you're shrinking the goods that are available to be bought. That means goods prices should go up. At the same time, if the economy really is weakening, the government is ultimately going to run bigger deficits. The Fed's going to have to monetize those deficits. I mean, they're not going to have to, but they will, because if they don't, well, everything's going to collapse. And so we already know that given the choice between allowing a financial crisis or any kind of crisis to happen or printing money, that's what they're going to do. They're going to print money. They're going to create inflation because they think that's the lesser of the two evils, and they have the ability to use that as their kind of, get out of jail free card, except it's not free. It's actually very expensive, but that's what these politicians do. And so a weakening economy leads to bigger deficits. It leads to ultimately a weaker dollar and, more money printing. And you have more people who are unemployed and not being productive, but taking their unemployment checks or their savings and trying to buy goods and services that they don't help create or produce. And you have more money chasing fewer goods. And so this is inflationary. But in the short run, the markets don't get that. So you got the rally in the bond market, and that kind of was like a domino. Gold rallied about $20. Again, why? Oh, weak economy means the Fed can cut rates. They think that's bullish for gold. Gold went up. What's bullish for gold is the inflation. That's why this number was bullish for gold, because it means more inflation, not less. It should have been bearish for bonds too, but the bond traders don't get that. But gold was up about $20. In fact, it's up another $5 or so this evening as I'm doing this podcast. We're now at about 1,920. So we were below 1,900 this morning. And so now we're back above that level. Again, I've been saying on this podcast, that's the support. Anything below 1,900 is a pretty strong buy. So far, anything near 2,000 has been a pretty good sell. But I think eventually it's the resistance at 2,000 that's going to give way, not the support at 1,900. In fact, I think the support is getting stronger as the resistance overhead is getting weaker. So the gold market went up. Dollar, didn't really make much of a move today. A little bit surprised by that. The stock market was up, not a huge move. We'll see what happens tomorrow. The NASDAQ, again, was up all day. NVIDIA, right, which is the leading the rally, or the poster child for the bubble of AI. NVIDIA was up about 3% today, ahead of their earnings, which were released after the close. And I haven't actually looked through those earnings. I know it was a big beat, and the stock jumped another 7% or so after hours, so up 10-11% on the day. Stock above 500, I think, when they stopped the overnight trading, if they even stopped it. But the last I looked at it, it had traded about $502 a share. Never been above 500 before. This is a new all-time record high in the stock. And so we'll see what happens tomorrow if it can sustain those gains. There have been a lot of days now over the last week or so where tech stocks have rallied but not been able to hold on to those gains, and they've sold off or closed lower. So to me, that is a negative sign. It's a sign of some topping. So I think it'll be key to see what happens to the market tomorrow, because if the market sells off in the face of this beat, particularly if you get a negative, day on NVIDIA, right? If it actually closes in the red after making a new all-time record high, that could provide strong evidence that this, 3-week correction that has started, the market peaked about 4 weeks ago, but that this correction could get a lot more substantial and may in fact become officially a bear market. We're still a ways from that, but that could obviously happen. Meanwhile, gold stocks very strong today with a strong price of gold. But again, still trading in the range. I think the GDXJ were up about 3%. Bitcoin, everything kind of went up today with bonds going down and the idea that maybe the Fed isn't going to be as aggressive